Are you expecting a recession this year?
The S&P 500.
Recession fears.
The S&P 500 is due for a 5% drawdown.
A massive sell-off on Wall Street tied to growing fears of a recession.
I think it should be great for us. I mean, I think it should be great.
The S&P 500 rose 87% over the last 5 years, while the actual economy grew just 12%. We are seeing market conditions that have only appeared 3 times in the last 100 years, and each time ended in complete disaster.
Shares in Lehman Brothers have plummeted more than 80% in 2008 alone.
There's a massive disconnection between the stock prices and the economy, and here's the problem. The market's current growth may not just be unsustainable, it might be dangerously overinflated. And today, it seems almost impossible to invest in the S&P 500 because of all-time high valuations, market euphoria, margin debt, political uncertainty, super investors are pulling out, and of course AI, which almost seems like
this is the greatest bubble story of all time.
Index funds has been known for steady returns and a place for effective diversification. And when the founder of the Vanguard 500 index, John Bogle, launched the first publicly available index fund back in 1976, his idea was to make passive investing through diversification both cheap and accessible to the everyday investor. He wanted you and I to be able to own a piece of the US economy through a low-cost index fund. A way to reduce risk without necessarily sacrificing your returns. It sounds pretty great, right? However, I've been investing in index funds for 12 years, but now I am wondering, are we really getting the same level of diversification at this point? Or are we just buying into an AI index bubble with excessive valuations? Has it really become impossible to invest in index funds in 2025? You see, the stock market has one fundamental purpose: to reflect the actual economy. Companies make money, they grow, and the stock prices should roughly follow. But right now that ratio seems to be completely out of touch. However, here is where things get interesting. It's called the Buffett Indicator, which recently caused Warren Buffett to sell all of his index stocks. It's the ratio of total stock market value to GDP. Essentially, it measures if stocks are reasonably priced compared to what the economy is actually producing. And historically, when this number crosses 120%, Warren Buffett calls it playing with fire. And therefore, if you look at the market capitalization of all the publicly traded companies in the US, as of January 2025, it's sitting at 202% of total GDP. This is the highest level ever recorded. Now let's try that again. The entire market capitalization of all US stocks is more than double the size of the entire US economy, meaning 202% of the value of all goods and services sold in the US economy. That's nearly double what Warren Buffett considers playing with fire. However, to put that into perspective, before the devastating .com bubble burst, this indicator reached, at its peak, 138% of GDP back in March 2000. And leading up to 2008 financial crisis that nearly collapsed the global economy, just around 110%. Now, try to imagine what might happen when we're sitting at 202%. It makes the .com crash look like child's play, but that's just the tip of the iceberg. The S&P 500 price-to-earnings ratio, one of the most fundamental measures of whether stocks are reasonably priced. However, the S&P 500's P/E ratio sits at 29.7 compared to its historical average of 16. And that means that investors are paying almost twice what they normally would for each dollar of corporate earnings. The last time we saw ratios this extreme was right before the .com bubble burst.
Boom!
And even more concerning is what's happening with the Shiller P/E ratio, also known as CAPE. This metric smooths out short-term fluctuations to give a clearer picture of long-term valuation. Today, the Shiller P/E stands at 37.3, which is dangerously close to its all-time high of 44.2 recorded back in December 1999. And do you remember what happened after that December 1999 peak? Yeah, the market crashed 49%. However, the Buffett Indicator and P/E ratios, these aren't just random numbers on a chart. We have reached and even exceeded the earlier danger levels that preceded every major collapse in modern history. But those things may not be the biggest problem. You see, when you buy an index fund today, you're not getting the diversified exposure you might expect. So, what are you really getting yourself into? You're getting yourself into the Magnificent Seven problem and how tech giants hijacked the index fund. Do you remember when index funds were supposed to spread your risk across 500 different companies? The S&P 500 has transformed into something I like to call the Magnificent Seven and Friends show, with Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla now controlling a concerning 32% of the entire index. That's nearly a third of every dollar you invest goes directly to just 7 tech companies. And during the height of the 2000.com bubble, the top 7 stocks made up approximately 22% of the S&P 500. This concentration isn't just a minor concern. Just 5 years ago, these same companies represented only about 15% of the index. But the problem is how this misrepresents your returns as an index investor. And why? Because if you strip out these 7 tech giants from the equation, the performance changes dramatically. The rest of the S&P 500, yeah, that's 493 other companies, has barely moved over the past year. It creates an illusion of broad market gains, but in fact, the majority of the returns come from a small group of tech companies. However, Nvidia stands out as perhaps the most extreme example of this distortion. Its stock price has skyrocketed by over 600% in just 2 years, not 60, 600. This single company has dramatically influenced the overall performance of the S&P 500, making the index appear much healthier than the broad economy it supposedly represents. However, it's not just that a few companies dominate the market, it's more that their stock prices are driven by hype and speculation. The Magnificent Seven trade at dramatically higher price-to-earnings ratios than the rest of the market. As of late 2024, the Magnificent Seven continue to show elevated valuations compared to the broader market. The PE ratio of these 7 companies was just around 45, which is significantly higher than the S&P 500 PE ratio of around 21 during the same period. Nvidia's valuation shows a much more concerning story. Its trailing PE ratio sits at 56, with a forward PE ratio estimated around 32. These numbers reflect extreme optimism about future growth, the kind of optimism that has preceded every market corrections in the past. However, what does this mean for index investors? What makes this situation so dangerous for everyday investors is how it fundamentally changes what you're buying when you invest in an index fund. The S&P 500 was originally designed to provide broad diversification across the entire US economy, spanning healthcare, financials, consumer goods, industrials, energy, and technology. But that diversification benefit has reduced significantly. And why is that? It's because the S&P 500 is currently being driven up by AI. So when you invest in the S&P 500, you're essentially making a concentrated bet on AI that doesn't even turn a profit yet, well, except for Nvidia, of course. And they all face similar risks: potential antitrust regulation, AI backlash, privacy concerns, and technological disruption. And with policy uncertainty on the horizon, maybe it's time to dial back risk a little and be selective with your exposures. However, if the stock market and the economy is out of touch with reality, what is driving up the market? Well, here's a hint.
Here's another hint. It's not number 2.
Margin debt just hit an all-time high, and euphoria follows. But what is margin debt? Imagine you want to buy stocks, but you don't have enough money in your account. Instead of waiting to save up, your brokerage lends you money so you can buy more stocks that you could afford on your own. This borrowed money is called margin debt. And how does it work? You put up some of your own money, called the margin. Your brokerage lends you the rest. If your investment goes up, you make bigger profits. But if your investment goes down, you can lose money even faster, and you may have to put in more cash to cover the losses. And this is exactly what we saw leading up to the 1929 depression and the 2008 crash. And we have been seeing it in today's market. And here's the scariest part. A report from Barron revealed that in January 2025, the US margin debt has reached the highest levels ever recorded of $937 billion. And this is where euphoria kicks in. And it goes like this.
Goes like this.
When investors feel unstoppable, believing the market will keep going up forever, they borrow more money on margin to buy even more stocks. And this drives stock prices higher and higher, creating a feedback loop of stock prices rise, investors get excited and buy even more. Then investors use margin debt. They buy even more stocks than they can actually afford. And then prices rise even further and more people jump in, thinking it's easy money. And this is where euphoria kicks in. Euphoria peaks and everyone believes that the market can crash. History has shown that euphoria can be a very dangerous early sign to a sharp correction. And if you begin to hear your Uber driver giving you guaranteed stock tips, maybe take the bicycle to work instead. Or we can do what super investors are doing. But what are they doing? Have you ever noticed how lifeguards start packing up their equipment before everyone else realizes a storm is coming? While you may be buying or consider investing into the market, the smart money is pulling out.
Smart money's on incentives.
Warren Buffett, the very man who told everyday Americans to invest in index funds, is now doing exactly the opposite. Buffett recently sold all of his Berkshire holdings in the S&P 500 index funds. And yeah, it's the same index funds that he's been recommending for years. Now I have to mention that those sell-offs was a tiny percentage of his overall portfolio. Instead of keeping his money in the market, Buffett is now sitting on a mountain of cash, $325 billion to be exact, the largest cash position in Berkshire Hathaway's entire history. However, Warren Buffett isn't alone in this exodus. Jeff Bezos, Elon Musk and Mark Zuckerberg have all been selling massive amounts of their own company stock in recent months. The scale and timing of these sales may suggest something much more deliberate. These insiders are reducing their exposure to the very companies they built. And keep in mind, these companies are a huge part of the Magnificent Seven that we talked about earlier. However, for anyone who lived through the dot-com bubble burst in 2000, this might feel a little familiar. In the months leading up to the 2000 market collapse, tech CEOs cashed out billions of dollars while publicly maintaining optimistic outlooks for their companies. It was almost as if they knew the party was ending before the average investor had any clue. Yet, there's another layer to this concerning picture. While all these billionaires are selling their personal holdings, many corporations are simultaneously engaging in record-setting stock buybacks. Companies are using their cash reserves to purchase their own shares at all-time high valuations, artificially propping up stock prices while the insiders cash out. It's a sophisticated version of pump and dump. But what exactly does Warren Buffett see that has him moving to the sidelines with $325 billion in cash? Well, he sees an overvalued stock market and has positioned himself not just to weather a potential correction but to capitalize on it, as he always do. So the real question here is, has it really become impossible to invest in index funds in 2025? No, of course not. I just wanted to caution you on the extreme market conditions and maybe get you to sit down and think twice and come up with a strategy.
This isn't strategy, this is...
Remember, this isn't about timing the market. It's about positioning yourself to weather any kind of storm while setting up your portfolio to thrive whenever conditions normalize. The index investing approach still works, but in today's environment it needs these crucial adjustments to deliver the results you're counting on. And I would really like to know, are you buying or are you selling? Are you optimistic or are you worried? Leave a comment below and let's have a chat. And if you made it this far in the video, I really appreciate it. I salute you and hopefully I'll see you in the next video.